Well, I feel like I might echo some of the points that have been made in this discussion so far. The role that we have within Schroders, I think we start from the perspective that climate change will be unavoidably disruptive to our investments and will be unavoidably a risk for all of the funds that we manage. So we think of climate risk very much in terms of the impact on all of our funds, rather than simply being about certain thematic funds or certain niche strategies. The first challenge that we face is really being very clear about what it is we're trying to solve. I think one of the challenges that we run into with a lot of the tools that are available is that it's not very clear what problem they're necessarily always trying to solve. Certainly historically, when there was a greater focus on things like carbon footprints, it was difficult to understand precisely how one would use that. So for us, absolute clarity on precisely what question you're trying to solve. And secondly, and I would really stress the usability point in terms of clarity and basically getting measures that are in the same units as investors typically deal. And fundamentally, that means dollars most of the time. So one of the things that I'll touch on quite a lot is that when we think about climate risk as an investor is measured in dollars or euros or pounds or Swiss francs. And we have to quantify it in those terms in order that it can be properly integrated into decision making and into risk analysis. If I turn to the next slide, the framework, and I've just got a couple of slides here, which will certainly not go into a huge amount of detail, but to give a sense of how we're trying to tackle those problems. The starting point really is one of we're dealing with a potentially seismic change in the global economy over the course of the next few decades. The implications of which will be far-reaching and will be very significant, where we don't have any historical precedent. We can't go and say, the last time this happened, here's the implications. This has to be based very much on logic and common sense, essentially, rather than being able to rely on empirical data. And it's also an area where there's a great deal of uncertainty about how this will play out. So whilst we know that governments in 2015 committed to limiting long-run temperature rises to below 2 degrees, it's not yet clear that that action is coming through quickly enough, and it's not yet clear that we will be on a trajectory to that rate of decarbonisation. So we separate the question into two. First of all, what is the timing and likelihood of seeing that transition to a low carbon economy? And secondly, what is the impact of a transition to a low carbon economy on the value of the investments that we manage? And what that allows us to do is it allows us to separate the question of whether those effects will play out from what the implications of those changes playing out will be on the funds that we manage. So if I flip on to the next slide, this summarizes the first of those. And again, there are various measures out there. So the various thermometers tracking how quickly we're seeing action to take us towards Paris. I've found very few that indicate that we're anywhere near the level of, or the rate of change and the level of action that we will need to get to a below 2 degree world. What we've done, and this is something that we update quarterly, we publish it on our website as well, that looks at a whole range of different measures, recognizing and starting from the principle that to get to 2 degrees, a lot of things are going to have to change. This isn't just about putting electric cars on the road or building wind farms or higher carbon prices. It's about all of those things and more. And if we look at each one of them individually, we can say, given the level of carbon pricing, given the rate of sales growth in electric vehicles, what long-run temperature rise does that individual measure imply? And we can then put all of that together to say, when we look at this in the aggregate, when we look at the overall picture, first of all, what's the long-run implication of that, which slightly concerningly in the top right-hand corner is about 3.9 degrees. I think there's two ways to interpret that. On the one hand, this is bad. That's what plays out. But secondly, or alternatively, as we would think about it, there is a huge amount of disruption to come as we start to see the commitments that governments have made start to transition into tangible action. So far, most of this has been talk. The real question will be, when does that really start to hit the road in terms of actual tangible climate action at a tangible and concrete policy level that starts to begin to have an impact on the value of financial investments. And secondly is the disconnect between different areas on the page. So, for example, if electric vehicles are growing at a relatively rapid pace, and they still are, albeit the car market has obviously come under some pressure, let's say, during the crisis, that's inconsistent with continued growth in fossil fuel, oil and gas production, which the oil and gas industry continues to see and continues to plan for. So this is essentially a way of giving us a fairly quarterly indicator of how quickly are we starting to see that transition play out. When do we start to see that shift towards a 2-degree world? When do we start to see the potential risks of climate change begin to crystallize as financial risks? If we flip to the next slide, that's in many ways the easy bit. The tricky bit is working out what are the implications of that transition for the value of investments. And we start very firmly from the idea of what problem are we trying to answer here, rather than what can we do with the data that's available to us. And this raises its own problems, which I'll come back to. But I think it's very important that we're super clear about precisely what it is we're trying to solve. And so we start from what are the things that will need to change to get us to a 2-degree world. And there are 4 main areas that we focus on: regulation, technology changes, fossil fuels being phased out, and unavoidably higher levels of physical risk. We say, how will that play out? What will happen within regulation, for example? The main lever of regulation is currently carbon pricing. And we can model what level of carbon prices would be needed to get us to a 2-degree world. And then we very heavily round it off to around about $100 a ton. And we can model by looking at the exposure that companies have through their own operations, through their supply chains. We can model the implications of that higher carbon price on their costs. We can say, well, if everybody's costs go up, then so will prices in many industries. And so we can then model price increases for different sectors. We can say, well, if prices go up, demand will fall, and that will vary depending on the demand elasticity of one sector versus another. And we can say, for every company, there will therefore be some combination of cost increase, price increase, and volume decline that we can use to assess, therefore, how will the profitability and the long-run value of those companies be affected by the transition to a low-carbon world and by carbon prices rising to $100 a ton. Similarly, with technology, capital allocation, fossil fuels and stranded assets, and unavoidably physical risk, we can go through a similar process that I won't go into, that essentially looks at how do we translate an understanding of what's likely into measures that we can quantify in dollars, and we can apply to individual companies or portfolios, with the overall conclusion that most portfolios are looking at something of the order of a 10 to 20% valuation risk under a 2-degree transition. And if I flip to the next slide and put that together, for individual portfolios, what that means is we can look at the cumulative effect of all of those different changes on the value of a portfolio or on the value of an individual company, or in this case of a global equity index. And you can see that in aggregate for this particular index, there's about a 13% value at risk. The majority of that comes from higher carbon prices. To some degree, that's a little bit misleading in the sense that within the growth category, the second one, there are some companies that will benefit and some companies that will lose. But it gives us essentially a way of putting in investment terms the implications of climate risk. And I think this is one of the biggest challenges that we face, is that so much of the measures that people tend to focus on are measured in tons of carbon rather than dollars of value. And one of the challenges of working in an organization where we have smart, thoughtful, and sometimes argumentative fund managers is that telling somebody that this company has a carbon footprint of 100 and another company has a carbon footprint of 200 doesn't really help very much in terms of them knowing what to do with that information. 100 is probably better than 200, but how much? What does that imply in terms of how that company should be valued? And you really only get to that point when you really think about the value question rather than purely the carbon question or the climate question. The other challenge that it creates, and just to finish off, is that when you go down the route of trying to understand what the implications of different trends will be, you end up running quite quickly into data problems. Climate change is an area where there is a huge amount of data, but it's not always the most useful data. So when I talked before about kind of measuring exposure to carbon prices, it's very straightforward to know relatively straightforward to get data at least on what emissions companies generate. Understanding their supply chain risk is an awful lot harder and required us to essentially build a whole new model to understand what exposure companies have through their supply chains. And there is I think certainly in our mind, a huge need for more data. There is no answer to this. We are all simply trying to get slightly closer to answering what is an incredibly complicated question. But I do feel, again, similarly echoing some of the points before, that certainly our commitment and our focus is on getting better at understanding that question, strengthening the way that we analyze that risk. And I think the more information, the more data, and the more people looking at that data that we have, the more likely we are to get to a better answer over time. So certainly that's our focus within Schroders, very whistle-stop tour of how we try and tackle the question, but hopefully gives a sense of the sorts of approach that we've taken, the challenges that we face, and a picture of the goal that we're trying to achieve.